right, here we are with Carlos Domingo, founder and CEO of Securitize. Carlos, welcome to the Defiant podcast. It's so great to have you here.
Hi, Camila. Thanks for inviting me.
Of course. 3 weeks ago, BlackRock launched a tokenized money market fund on Ethereum, and Securitize is the transfer agent for the fund. This tokenized fund, called the BlackRock USD Institutional Digital Liquidity Fund, or ticker BUIDL, has attracted over $280 million by now since its launch. So far, so good. Carlos, this is just such a big milestone for crypto and the blockchain industry. Really interested to get into all the nitty-gritty details of this and talk about real-world assets, tokenization more broadly as well. But to start, would be great if we can just start from the basics. And if you could explain how this fund is structured.
Sure. So just to clarify, the role of Securitize in the project is threefold. So we are the transfer agent for the fund. Then we basically have done all the tokenization work of issuing the token, the smart contracts and everything. And then we're also the broker dealer. So we're the ones that are distributing the fund. So we kind of played three different roles here.
Oh, perfect. And we'll get into that for sure.
Sure. So this is a fund that is for qualified investors, for qualified purchasers, for institutions. It's basically a private fund that invests 100% of its assets in cash, U.S. Treasury bills, and repurchase agreements. And then, as you mentioned, is being issued in the public Ethereum blockchain, which I think is a great milestone. It has a net stable value of $1 per token, but then there is a daily dividend that is accrued, and then every time there is distributions, which we do it on a monthly basis, every investor that has a wallet that contains tokens will get the pro rata tokens corresponding to the dividends that have accrued over the month, right? And the whole idea of this is basically to bring an institutional cash management product, on-chain that, provides all the advantages of tokenization, about, faster issuance and trading peer-to-peer, transparent settlement, etc. As you know, these are repurchase agreements and short-term treasuries, 3 months treasuries. So they generate a yield based on the Fed rate. And then, as we accrue the yield, we start paying it to the investors. Actually, BlackRock accrues the yield because BlackRock is the investment manager. We just distribute the dividends to the investors.
Are these additional tokens transferred to each kind of non-custodial Ethereum address? Or how's this process of, buying these tokens? Like, do you need to create a custodial address? Is this a more kind of off-chain process, or is it actually done on-chain, with dealing directly with non-custodial Ethereum addresses?
So there is an off-chain process of the onboarding an entity. So obviously what we're sending is security. So the token represents a security, which is the units in the fund. Once somebody has created an account with Securitize, we're responsible for that part of the project. So you pass KYB, we create an account in our platform, and then you have to register a wallet with us. And then we offer, flexible custody options. So, you can register your own self-custody wallet if you want to, or you might have seen on the announcement that we announced that there's all the custody solutions that we support. You can use Fireblocks, which is a custody technology, as you know, or we also have worked with, BitGo and Coinbase Custody, which are qualified custodians, and then Anchorage, which is a federally chartered bank that also can do custody of the tokens. So those are the 4 options that are available. Well, the 5, because one is that you just get your MetaMask wallet, but I don't think anybody institutional that puts $5 million will use a MetaMask wallet for this. So we do have, professional custody options. And then once the tokens are the tokens represent the units in the fund, right? So that's the only way to get access to the fund, is to hold these tokens. And then because we know the wallet address of the investor, then every time we need to pay dividends, we will just send the tokens directly into the same wallet that holds the other tokens. And if you, for any reason you transfer your tokens to another, whitelisted participant, as a different wallet that belongs to a different investor, peer-to-peer, then, the next time dividends are being paid, we'll go to that other wallet. So.
And you need to be an institutional investor to be able to register.
That's correct. So this is not a retail product. This is a fund for institutions, for blockchain institutions. And we can talk later about the different use cases that we're seeing on here. But yes, it has to be what is called a qualified purchaser. So a qualified purchaser is somebody that holds a minimum of $25 million in investable assets.
And then from there, once a holder has purchased the fund and has these tokens, can they be transferred in the secondary market?
They can be transferred to another qualified investor. So we are onboarding a lot of entities now. So once somebody has been onboarded and their wallets have been whitelisted, they can send it to somebody else that has been whitelisted as well. And that happens on chain. There's no intervention, manual intervention. It's in a decentralized way if you want. And the transfer is a valid transfer is controlled by a smart contract infrastructure that will approve the transfer from an Ethereum wallet to another Ethereum wallet.
Is this done in like a specific exchange or like a platform that's made for these types of transfers?
So the transfer is peer-to-peer between two investors. So you don't need like a platform or a marketplace to trade them. The fund is also liquid, so you can send the tokens to a redemption wallet, and you get dollars in T+0 settlement if you want to liquidate the fund. So I don't think for this type of funds that like a secondary market platform is required because of the nature of the fund. We do have a license as an alternative trading system as part of our broker-dealer that allow us to actually trade in secondary market, digital asset securities, right? So tokens that represent securities, but we're not using it for this project.
Okay, got it. And so that leads me to talking about Securitize itself. Like I've seen you offer different really interesting products. Besides this one, you have private equity funds, venture capital funds. So yeah, if you can talk more about what you do, and also I'd love more background on yourself, like what led you to start Securitize. Sure.
So yes, Securitize, we are a tokenization platform. We've done a ton of projects over the years, so of a variety of things. We've tokenized equity. We did a very successful project with a crypto company called Exodus that tokenized their equity on a Regular Plus offering and raised $75 million. But currently, where we're really focusing is on what the part of the market that is called alternative investments. So these are, private investments that typically are very hard to access. So things like, as you mentioned, private equity, credit, etc. That those type of products are generally not available to normal investors. They are only for institutional investors, or they're only available for ultra high net worth. And through tokenization, we're trying to kind of democratize access to that asset class, and that's why you've seen that we have a variety of products, mainly from tier one asset managers. So we've been working before BlackRock with KKR, Hamilton Lane, etc. So that's kind of the focus of the tokenization projects that we do. And then in terms of how I ended up here, so I've been in tech all my industry. I don't have originally a background from financial services or things like that. So my entry into the space was through the technology. In 2016, I came across Ethereum after it launched, and that was when a lot of the ICOs started. And I thought the technology was fascinating, right? Because you could just send ETH and then get a token that represented some sort of economic interest in a project, and then you can go and trade it somewhere else, etc. And there was also at the very beginning the first DeFi protocols like Bancor, where you could actually create automated market making, etc. And I thought it was fascinating. And my first thinking was why people do not apply this to like traditional finance, right? Because all these advantages of making it very simple to invest, making it liquid, etc. This is exactly what's missing in private markets, right? So as a tech entrepreneur, I've been investing in other startups of colleagues. I've been investing in VC funds and in funds on funds, and it's just like a very cumbersome process. It's very inaccessible. The investment process is very lengthy. There's no liquidity. etc. So I was attracted by how this technology can actually be used to basically digitize, capital markets and make them more accessible and more liquid, etc. What I didn't realize is obviously that all these ICOs that were very cool, for the most part, were illegal because they were basically selling securities. And what we wanted to do was tokenize traditional financial services products. So those are securities from the get-go. There's no question about it. So we then embarked on a long journey of figuring out, from a regulatory perspective, how we could actually do that, but in a legal way, right? So what licenses do we need it? How do we need it to build the tech to make sure those tokens, follow regulations, etc. So in 2019, we registered as a transfer agent, which is the regulated entity with the SEC that basically is capable of issuing, securities on behalf of an issuer, managing those securities, doing asset servicing, like we say, the redemptions in the case of BlackRock, or pay dividends or other things. And then subsequently, we got a broker-dealer license that we launched in 2021 that allow us to sell these tokens that do represent securities, as well as trade them on the secondary market. And I think at that point in time, when we had like the 3 licenses, is when the opportunity to participate in projects like the BlackRock one, or previously with KKR and Hamilton Lane, started to be a reality.
So far, real world assets have become one of the major narratives in crypto. I think there's a consensus on how important it is to bring securities and traditional assets on chain. Right now, we just surpassed $1 billion in tokenized U.S. Treasuries. What's your view on how this ecosystem will progress? I mean, do you see a future when all assets live on chain? Will it be more of a balance? Does it make sense for everything to be on chain, or maybe some assets are more suited for these distributed networks, and some are not? Like, what's your view there?
So from a conceptual point of view, you could think of all assets being on chain, right? Why not? Like, when you own an asset, whether the asset is a equity or a bond or a fund or whatever, somebody needs to record the ownership of that asset on a ledger, right? Because somebody needs to know that you own the asset. And if you want to transfer it, you have to update the ledger saying, no, I transfer the asset from investor A to investor B, and somebody needs to pay for it. So they need to move also the cash that people pay for it. So if you think about what a blockchain is, at the end of the day, is like the ultimate ledger, right? It's like a public distributed ledger that has been designed precisely for that particular use case of owning an asset and being able to transfer it in a very efficient way. And on top of that, today we have the ability to represent securities like this tokenized money market fund alongside cash, like stable coins, right, which are tokenized cash. And then they are in the same ledger, so you can actually move them in a synchronous way, in a very efficient way, which is another problem in capital markets, right? Like if today I want to sell you, shares in Securitize, I need to send you the shares, but you need to send me the cash, and those things move in completely different rails. So that's what creates inefficiencies in the system, it creates counterparty risk, etc. So from a conceptual perspective, everything should be tokenized. Now, in reality, I think that capital markets do function and people trade things all the time, and they have inefficiencies, but they do work, right? So I think that there's parts of markets that will be very difficult to be penetrated by tokenization, because you will have to displace existing infrastructure. And for that, probably the best example is public markets, right? Like today, public markets have a series of inefficiencies, but they work very well, right? You can go to Robinhood, you can open an account with them, and you're trading Apple shares right away, and you can buy fractional shares, and you can see, you do a trade and you see the shares showing up in your account, even though you actually don't own them, and the trade hasn't settled, but you give the impression that it's very efficient, right? So, and that is because they have a massive amount of infrastructure and also a massive amount of regulations to make those markets work. So I think that will be the last part to be tokenized. On the other hand, on private markets, like the stuff we do with KKR, Hamilton Lane, or now with BlackRock, as well as all these private assets like, let's say, real estate, etc., they don't have any infrastructure. So you're not displacing anything. You're just basically creating something from scratch, because those are markets, for the most part, they're really not digitized at all. And also from a regulatory perspective, it's easier to basically introduce blockchain and tokenization in those markets. So this is why our focus is there. And if you look at where everybody's focused on real assets, it's primarily private markets, right? This is money market funds and treasuries, etc. It's credit, it's real estate, etc. So I think the industry in general tends to agree that that's where we should start. And then today, that's like, say low single digit billions. And then we need to get that to $1 trillion before we start tackling more difficult problems. So they're huge and they're growing, right? So there's an infinite amount of things we could tokenize there without going somewhere else.
Summer.fi is aimed to be the best place to borrow and earn in DeFi. It provides curated access to top DeFi protocols like Maker, Spark, Aave, and Morpho, with stop loss, advanced automation, and one transaction multiply to increase exposure with ease. The access to all these protocols is better on Summer. With $4.25 billion managed, nearly $270 million in total collateral automated with 100% success rate, switch to Summer.fi and discover new DeFi opportunities. What's the significance of BlackRock getting into tokenized assets?
So I cannot speak on behalf of BlackRock, but as Securitize, I can tell you that, for us, this is a very, very important partnership. BlackRock is the largest asset manager in the world. And the fact that we've been selected as their partner, and as you might have seen, they also have invested in our company and taking a board seat, it's actually something that, I think that will, help us move the tokenization market forward in a dramatic way, as opposed to a lot of the other stuff that we were doing before, because of the significance of who BlackRock is.
Right. That's where I was going with the question. I mean, do you think that, having the biggest asset manager in the world put a fund on chain, do you think that will that inspire other asset managers to do that? I mean, what kind of impact do you think this move will have on the industry?
So look, when we announced the project with KKR before Hamilton Lane, before BlackRock, KKR is not BlackRock, but it's also a very large asset manager, a very reputable firm. We very quickly got Hamilton Lane, also doing tokenized funds, and we had a really good pipeline of projects from other asset managers that approached us at that time, because obviously they saw that, this is kind of like, somebody has to be the first, right? And getting the first one is always the most difficult one. Mm-hmm. But when somebody's there, then other comes until everybody wants to do it, right? Unfortunately, what happened is that, then the crypto industry went in complete disarray, because they started having, the Terra Luna debacle, and then you had, Celsius and BlockFi, and then the whole FTX atu, etc. And I think that, kind of gave pause to a lot of people because of reputational concerns towards the crypto industry, right? I don't think asset managers want to be associated with, fraud or illegal things happening in the space. So unfortunately, that has slowed down things for a period of time. I think now we're in a better situation. I think, whoever needs to be in jail is in jail. Whoever, needs to pay a fine has to pay a fine. And whoever went bankrupt, and that's it. And they're no longer there. So I think that now that BlackRock comes, which is significantly more important, especially because of the nature of the project, then we probably will see what we've seen already, like a lot of asset managers that we've been talking to, and some that we've never talked to, that they have approached us to understand, how can they actually do something with their assets as well and make them more productive, putting them on chain.
Super interesting. So from this move, I think, there's at least two insights. And one is that it seems that so-called TradFi or Wall Street seems to be, coming to terms with crypto again, or I guess there's not that kind of reputational risk related to the industry after, like you said, a very, very tough year. So it looks like we've kind of overcome that, those dark times. And I think the other insight that's super interesting is that these funds actually, making those first steps into tokenizing assets will, give more confidence to others, for others to follow their lead. And I think, the big names that are actually willing to do that will just, give way to more asset managers, more financial institutions following their steps.
I think so. I'm pretty convinced that we're going to see, I've been in this industry for 6 years. I, believe in tokenization in 2018. Unfortunately, it didn't happen. It didn't pick up for a variety of reasons. I think primarily, that, first the companies like us, we didn't have any licenses. There was no regulatory clarity. We were just like a tech provider, etc. And then the crypto industry went also in a completely different direction. I think today we have a confluence of two things happening. One is, entities like Securitize and others that have licenses that can actually work with these large asset managers in a regulated way. Which obviously they need that. They're not going to just go and, do some random thing on a DeFi protocol because, that has a lot of, risk for them because it's not clear whether it's legal or not. It's permissionless, anonymous. You don't know who the counterparty that you're trading with is, etc. So that's not going to happen. And then the crypto people, I think after all the debacle that we went through the last couple of years, they've realized that they need to do something productive with blockchain if this is an industry that is going here to stay and is going to grow, right? And the real world asset term is a bit of a terrible term. But on one hand, it's interesting that crypto people call this real as opposed to what was happening before, which was not real, like issuing imaginary internet money that people were doing it there to sell it to other people, etc. That's not very sustainable. So I think that we're in a path now of building real businesses and sustainable business in public blockchains and with crypto infrastructure that will, in my opinion, come primarily from, taking financial assets and putting it in there.
Yeah. And related to that, what use cases are you seeing for this BlackRock BUIDL fund? Like what's the intended holder or investor for this token, and is it just an investment product, or what are the different use cases that you think this token can have?
Well, so this is a cash management product, right? So that's what treasuries and things like that are. You instead of you having cash, you need to put it somewhere that is as close as possible to cash, so you're not taking any risk, but that provides a yield. And that's what people do in traditional markets. So that's what we bring in Onchain. So any of the market participants can actually do three things with it. One is obviously treasury management. That's the low-hanging fruit. There is a lot of people out there that has their own treasury of the, crypto companies raise a lot of money. Foundations, DAOs, etc. have a lot of reserves, and some of those need to be in a place that is safe for them to be able to use it when they need it. But at the same time, if they can actually provide a yield to it, then it's much better than just keeping cash or keeping stable coins. And we're crypto friendly in that respective. So obviously we do still have to do KYB and onboard the entities, etc. But we will probably be able to work with all those crypto native companies to be able to help them with treasury management. And they will have it on chain. They will not have to deal with traditional banking rails. They will not have to open bank accounts or brokerage accounts, etc. So that's one use case. And then the second one is derivative products, right? So people have been building tokenized treasuries and things like that without actually having a good connectivity with the underlying, because the underlying was not on chain. So now you have something that is, as robust as possible because it's managed by BlackRock, where you can build derivative products that could do other type of functionality or could provide other, variations of what's the basic money market fund. And the third one, which is very interesting as well, and recently the first company that announced that is going to do that is FalconX, is taking this as collateral for trading. Today all the trading firms, the prime brokerage and the trading facilities, you need to post collateral to be able to trade and settle the trades. And then they're posting stable coins. They could post the BUIDL fund and is earning a yield. and they'll be able to liquidate it because it has daily liquidity with T+0 settlement. So it could replace stablecoins for that particular use case. This is not a stablecoin, by the way, just to make it clear. This is a security, but people today are using stablecoins for something that in TradFi people don't put cash for those things, right?
Interesting. So from the point of view of holders, why would it be better to own the BUIDL or build BUIDL, fund rather than just straight up holding U.S. Treasuries?
Well, this is a question that people ask me, like, oh, I already have treasuries. Like, I talk to a lot of companies, and some crypto companies do actually have access to proper bank accounts or treasuries. And they ask me, like, oh, why should I just like move my, I don't know, whatever, Goldman Sachs treasuries or JP Morgan treasuries and put them on chain with BlackRock? I was like, well, aren't you a crypto company? Isn't that your whole mission, to have things on chain and disconnect yourself from the traditional banking rails and financial market? So it's very obvious that if you're a crypto company, you should just go with your own beliefs of putting things on chain and manage them on chain. And by the way, this will be much more efficiently managed because it's on chain, right? So you will not have to deal with banks with risk of the bank closes your account, like it has happened in the past for many crypto companies. You will not have to deal with, you want to do redemptions and then you have to wait, etc. So I think that for crypto companies, it should be a no-brainer that if you have a product that is as institutional and as safe as the one you can get from a traditional bank, you should just do it on chain if you have the option to do it, which today you have now with this product.
What about for just, traditional non-crypto companies?
I think traditional non-crypto companies probably have less of an incentive to do this, right? Because first, they do have access to those traditional products, those TradFi products already. And this is just the same product, but it's on chain. And second, they don't necessarily benefit from the advantages of being on chain because they do not operate on chain at all, right? So they operate on traditional rails. So I don't think that this product in particular is attractive for TradFi people. Some of the other tokenizations that we're doing, and like for instance with Hamilton Lane, the idea is to basically leverage tokenization to reach to investors that do not have access to those products. But this is not the case with the BlackRock fund.
So, say, not even in terms of fees. Like, would fees be lower on this fund? I don't know. Maybe there's some sort of reduced cost because of I don't know. Transfers are cheaper, fewer intermediaries, or
So there's certainly. Not that fees specifically are cheaper. Also, to keep in mind that fees depend not on the efficiencies of the management, but also on the scale. And there's money market funds out there that are huge. This one is just starting and it's 280 million, which is great, but it has to grow much bigger. There's certainly advantages on the transfer, for instance, because it's basically you don't need to ask anybody. Like if you want to transfer your securities from, let's say, Morgan Stanley to JP Morgan, it's going to take you like 1 or 2 weeks to do it. Or if you want to transfer to another investor. So I think that this obviously provides, and it's going to cost you maybe money, some fees or etc. So this obviously doesn't have those costs, but you have to live on chain, right? Because the transfer happens on chain. So TradFi companies do not have wallets or do not have custody accounts with like Anchorage or somebody like that to be able to do those things. So unfortunately, the crypto economy is kind of like isolated from the rest of the economy, right? Like this economy that lives here and there's the crypto economy that lives here. And today they're not particularly well connected, and advantages of things you can do in crypto are very hard to bring to the non-crypto people because they do not have, access to the infrastructure, and the infrastructure of crypto is still, kind of difficult to use, right? Like using wallets or opening accounts and things like that.
So the holders of this BUIDL fund will be mostly crypto companies?
Yes. So far, everybody that has invested is a crypto company.
Have you heard about Safe? They're not just pioneers in crypto custody, but they're also leading the way with smart accounts. With Safe, managing your crypto is smarter and safer than ever. They've secured over $100 billion in total value and are available in more than 15 networks. SAFE is also revolutionizing the industry with their full compatibility with ERC 4337, making it super easy to integrate wallets into your daily crypto activities. And for crypto enthusiasts, SAFE has something special: the SAFE Pass Activity Rewards Program. Launching soon, it's a fantastic way to engage and earn rewards. So what are you waiting for? Visit safe.global, sign up for the SAFE Pass Activity Rewards Program, and secure your spot at SafeCon during the Berlin Blockchain Week. Be part of the transition that's setting a new standard in the world of custody. I think this is transparent, but how many holders or how many institutions have been interested in this fund or are holding the fund?
So the ones that have purchased already, I think it's been 10, if I remember correctly, as of today. That's very small. Obviously, we just started. We opened this a week and a half ago. We are onboarding a ton of other companies. As you can imagine, we until this was not public, it was very hard to talk to people about it because obviously the fund was not live and nobody knew it existed. I think now that this is public news, we're getting a lot of interest, meaning like hundreds of leads, literally, that came to our website or they reach out to us that are interested in the fund. And then it takes time. You need to explain what the product is. We act as a broker-dealer, so we have to have the broker-dealer representatives of Securitize being a part of the discussion. We then need to onboard the entity, which, sometimes this takes time, etc. So I think we're going to see a ramp-up over time of the fund, and it's clearly on the path of becoming the largest, tokenized fund ever at the pace that is growing currently.
You said that when you started offering this KKR fund that you saw a lot of interest from other institutions of doing their own fund, issuing their own funds. Has the same happened after announcing this BlackRock fund?
Oh yeah, certainly. I think we've got some of the people we were talking to. I think that we're going to move them to the finish line because before they were still like, should we do this or not? Like how it works? Is it safe? Is it legal? Is it etc.? So now when they see that somebody as large as BlackRock has done it, they probably a lot of their concerns about it, they go away. And then of course we've got like new people that we've never talked to that suddenly has approached us to do tokenization projects. We've also, interestingly enough, seen crypto companies that have tokenization ideas that now have come to us and say, oh wow, so we also want to tokenize this or that. So we'll probably going to see a combination of both, like try to find people that we tokenize stuff for them, as well as some other ideas coming from the crypto space that will be issued as tokenized funds.
Interesting. Okay, so we should see new tokenized funds coming up soon.
Yeah, I hope so. Well, I mean, it takes a process because obviously you need to, these are securities, right? So you need to get everything in place. You have to write a PPM because it has to be like a legal document with all the disclosures about what the fund does, etc. So this is not like immediate that you can just sign up somebody and issue a tokenized product in 2 weeks. But yes, in the next coming, weeks and few months, we should be able to see a lot more products coming into space, at least from us. Yeah, certainly.
Super interesting. And without obviously getting into the details or names or anything like that, but just to get an idea, what are some of the most interesting tokenization ideas that you're seeing right now?
I think that obviously, if you look at the tokenized real world asset space today, there's kind of like two things, right? One is treasuries, which since we entered the space, we've moved the needle to over 1 billion, and now it's growing, etc. The second one is credit. In a market where interest rates are high, credit also private credit has even higher interest, right? Because it's all the type of loans. And then if you think about like the next 12 to 18 months, interest rates are going to go down. Possibly you will have tokenized funds, tokenized money market funds and treasuries being slightly less interested for people that want to have a higher yield and take a little bit more risk. So I think that's where private credit will start and enter the space. And then I think that's kind of like the next wave where we already have a very good product with Hamilton Lane called Scope that we're seeing a lot of traction. But I think that's an area where we are looking at, issuing more products. And also we can bring like institutional grade, tokenized private credit into the space, because we do have access to large asset managers that have credit platforms, as opposed to a lot of the tokenized credit today, which obviously, don't want to, it's been great and is very innovative, but it's perhaps not the same institutional grade as the ones that we have today or we can get access to.
Can you get more specific on what these tokenized credit funds actually are? So what's kind of the underlying asset that's being tokenized?
I can speak, for instance, about the one we have already on the platform from Hamilton Lane. So in capital markets, the last 2 to 3 years, there's been a kind of a shift from banks being the main lenders to private credit, kind of growing a lot, right? So, and the reason is because obviously banks with all the banking crisis that happened and, some banks going out of business, etc., they've become more conservative in terms of what do they do with their deposits. So basically banks take money and then they lend it out to be able to earn a yield and be able to, pass that, keep that as a profit to run their operations and make money, and then also pass a little bit to their deposits. But as it happened with the banking crisis that we just went through, if you take a lot of risk with those, with those loans that you produce, then you can and you have a bank run, then you can basically default because you don't have access to the underlying products. So private credit is very different, because private credit is basically private investors that they want to generate a yield, and they basically give money to a manager that will then do these loans and will lend to other people. And this is private money, right? So if it goes away, it goes away. It's an investor that loses money. It's not my deposit on a bank that disappears, which people, when they put money on banks, they assume that the money is always there and it's never going to disappear, which unfortunately has happened in the past. So private credit has been growing a lot. This is basically loans, right? So you're a private company, you need to borrow money. You could go to a bank, and today you're going to have a hard time getting a loan, or you can go to one of these private credit funds, and then they do the due diligence and they decide to extend a loan to you, and then that loan generates a yield which is passed to the investors in the fund.
So in the case of these funds, is it like a bundle of many different loans?
It's a bundle of loans. Yeah, that's a very good way to describe it. A bundle of loans extended to private companies for the most part.
What do you think is missing for this link that's a bit broken that you mentioned before, that between the kind of real world economy, if we want to call it that, and the crypto economy?
I think that, look, the crypto economy moves in different rails, right? So you require wallets, you require stable coins to pay for things, etc. The real world economy, like let's say a normal person, probably doesn't have a crypto wallet, probably doesn't know what USDC is, etc. Right? So I think that for crypto to really be pervasive and being used across every single thing, we need to somehow get this infrastructure to be kind of like invisible, right? To be underneath everything that people do. So I want to ultimately open my phone and being able to receive USDC there and or send it or have held tokens that represent a fund or whatever, without having to go and open a wallet, download an app and things like that, right? So I always explain the same thing. Like when internet started, you're too young, but I'm much older, so I remember that when internet started, you actually had to, like, people don't remember these things, and young people have never experienced that. But if you wanted to connect to internet, sometimes you even have to download software, because the whole TCP/IP stack that allows you to basically connect to the internet It was not even installed in the PC. And then you have to have a modem, and you needed to connect to a phone, and you wanted to connect, and you need to like go through like a click here, and then wait a little bit, and then I'm connected to the internet. And then over time, internet became invisible. Like you open your computer, you open your phone, and you are on the internet. You don't even realize that you're on the internet. You don't have to do anything, right? The internet is just there. And that's what made internet so valuable, right? Because it was just there for people to use it. So I think that if you think of a public blockchain as another, let's say, a next generation infrastructure, public infrastructure that is there, that provides all the functionality that the internet does not provide, which allows you to move to transfer value in an efficient way. For this to really be pervasive the way that the internet is pervasive today, you need this infrastructure to be as invisible as possible across all the devices that people use on an everyday basis. And I would definitely not there. So
yeah. So right. So we need blockchain to become invisible, and I guess that means that all of the user experience, like the apps that we use that are crypto based, need to make it so that we don't know that we are using blockchain as infrastructure. Like it needs to be as seamless as using any other app.
That's correct. I think that's the problem, right? So I think like somebody I've been in tech all my career, I somehow feel that the blockchain space, which is already 10 years plus old, you will think that it will have make more progress. But I think there's been so much focus on infrastructure and building another one, stuff like that. And instead on more protocols, and then now L2s, and now I was reading that they're building now L3s. And I think there is not enough people that are focusing on the user experience layer to try to make it more seamless. And unfortunately, the large tech providers like say Apple for phones or Microsoft or Google, etc., have not done a good job of integrating blockchain in their apps to make it more seamless. Probably because they've seen a lot of the controversial things, if you want, or fraud or things happening in the space, and they probably don't think that this is where they should be doing. I for instance, I'll give you an example. I use the Brave browser, which was developed by Brendan Eich. Brendan Eich comes from Mozilla, so obviously and before that from Netscape, so he knows about browsers probably more than anybody else. And the Brave browser has a wallet. It's there. I don't need to install a wallet. It's all there. Like if I want to use it, it's very seamless, etc. So of course, Brave is not the dominant browser, even though I think it's growing quite nicely. But if you get Brave and Chrome and Safari and everybody to just like integrate wallets over there, then suddenly you have access to wallets without having to even think that you have a wallet, and it will make it easier for people to then consume crypto products, right?
Yeah, I wonder if that experience will end up coming from the incumbent, Apple, Facebook, Google, and so on, or if kind of Web3 will be led by new crypto native companies, because in the end, like it's maybe the incentives aren't there for Apple to build and to integrate like an open source system. Like they are a closed company. I don't know, it's kind of against their ethos.
That's true, right? They integrate TCP/IP to communicate over the internet, which is an open source protocol. So I don't think
that's true.
So I don't think it's because crypto is open source that the closed source companies like Apple do not integrate. Apple integrates a ton of open protocols. Email is an open protocol. Voice over IP. Like there's so many stuff that you can do with Apple products that are there. I think and by the way, just to give you another example. I used to work at telecommunications a long time ago. And then at that time, and I'm talking like 15 years ago, there was the whole notion that you could actually pay with your phone on, through NFC or some other like a near protocol. And then your phone becomes your payment mechanism, right? And that this technology that has existed for a long time. And when it's really, really taking off is when Apple put it on their phones. Like now everybody has Apple Pay, and then that forced the rest of the infrastructure, the payment devices in the stores and everything to upgrade, to be able to pay with this. And then there were companies like Square that enabled, funds to be used for payment with credit cards and other mechanisms, and they got these points of sales devices in the stores, etc. So I think it's a combination of new innovative companies, but you need to get the large incumbents, as you said, tech providers that control the entry points of the ecosystem to adopt this. And it's the same thing happened also when the internet started. Until Microsoft didn't put a browser by default in their operating system, because at that time everybody used Windows as their main operating system in their computers, it didn't really take off, right? Because the friction of having to download a browser, made a lot of people not even think about it. But once the browser is part of your operating system, now it's inconceivable to buy a device that doesn't have a browser, right? So at some point in the future, it will be the same thing. It will be inconceivable to have a device, whether it's a computer, laptop, or a phone that doesn't have a crypto wallet connected to, whatever ends up being the dominant blockchain.
Protocol 20 introduces Sorbonne, which is Stellar's cutting-edge smart contracts platform. This creates new surface area for innovation and provides new opportunities for developers to build protocols and products that create access to everyday financial services. So it means a gradual increase in transaction capacity and a chance to fine-tune applications. And it's the most transformative upgrade to the Stellar network to date. Woohoo!
Makes sense. And then on the same line, I guess we could extrapolate that to the financial industry, like with what BlackRock is doing. Maybe the way that crypto becomes mainstream is with more of the incumbents in finance to incorporate blockchain infrastructure into their operations.
That's correct. I mean, if you think about why the Bitcoin ETF has been so successful, is because that's a gimmick to take a Web3 asset like Bitcoin and wrap it around a Web2 asset, which is an ETF, and being able to be compatible with the traditional infrastructure. And that's why the Bitcoin ETF took off, right? But it could have taken off in a different way of all these people that allow you to keep an ETF in their brokerage account to just basically accept Bitcoin as a deposit and integrate a wallet there, right?
Right.
But because they didn't do that, then the crypto people and then other institutions like BlackRock came up with the idea of, okay, so I cannot have a Bitcoin in my, let's say, retirement account, or I cannot have a Bitcoin on my brokerage account. So let's wrap Bitcoin around this legacy format, if you want, like an ETF, and then put it there. So, but this is not going to happen with all the crypto assets, right? And we, by the way, when we do tokenized funds, this is a bit of a barrier to sell to the TradFi people, right? Because sometimes they want to be able to keep it on their brokerage house, or they want to be able to integrate it with the investment advisor platforms, which we bought a company last year called OnRamp that enables us to do that for digital assets and tokenized funds. And you have to kind of break these barriers of integration of crypto assets with the non-crypto part of the world. Yeah.
So I think that it's even more significant than that this fund was launched on a public blockchain. It's because it's instead of like trying to wrap an asset and bring it onto traditional rails, it's the opposite. That's what. Yeah.
So the ETF is Web3 into Web2. This is Web2 into Web3.
Yeah. Do you think the future is a mix of these two models?
I mean, things are always a mix for a period of time, right? Like, again, I remember when I was a kid that some people still had black and white TVs, and then color TVs became predominant, and then flat panel TVs. But some people still kept the black and white TV, or those TVs that are not flat, that have the big thing. Over time, they end up disappearing, and the superior technology becomes the dominant one. But it doesn't happen overnight, and it doesn't mean that just because crypto is better or you can do more things, everybody's going to go and migrate there. That's I think it's a misunderstanding of how the cycle of adoption of technology works.
But do you think that's the end result?
I think the end game is always that the better technology prevails, right? It has happened everywhere, and there's no industry that has not been digitized. I mean, if you think about music, when was the last time you purchased a CD? Long time ago, right?
Yeah.
But for a long time, people were they have digital music and they were still buying CDs, and they coexisted for a period of time until eventually, the analog formats like the LPs or the CDs primarily disappear. I'm still probably there's still people buying them, right? Like it's probably a very, very residual part of the market that still buys, buying LPs or CDs. But for the most part, 95% of the industry is just pure digital, right? Mm-hmm. So every single industry has been digitized, and there's no reason why financial markets will not be digitized. Now, the problem is that some industries are easier than others because, it's everything that is regulated and has a lot of infrastructure to make it work is a lot more difficult to displace. So I think this one will be a harder one to crack at scale. It will happen, yes, but is it going to happen in 10 years or is it going to take 20 years? I mean, if you think about it, the music industry itself took probably like 20 years to be fully digitized, right? Because I don't remember exactly when iTunes started or the iPod, but that was probably like 20 years ago, even before that, right? So, and that was kind of like the very beginning of digitization. So it took 20, 25 years something to be adopted. So this one, we're not even halfway through, right? Because blockchain is not even 10 years. And if you think about really blockchain as a more fully functional thing, is probably more like 5 or 6 years, I would say.
Yeah,
because Ethereum launched
pretty early
in 2016, and then there's a lot of stuff that like stable coins that didn't exist until later, or there's a lot of like key management technology like MPC wallets that also didn't come until later, etc. So in reality, you have a functioning platform for maybe the last 4 or 5 years. So you're still at the very beginning of the journey if you compare with other industries. And on top of that, you're operating on an industry that is much more complicated because it's highly regulated, because it touches money, right?
It's pretty exciting to think that we are in the in the just like very early first few years of the digitization of finance, and that this BlackRock fund is one of the handful of funds that were first to actually go on chain.
Yeah, we're at the very beginning. Sometimes I think like I maybe started my company too early, right? Because it's on one side, it's exciting to think that we're at the very beginning. So there is so much that we can do in the future. On the other hand, this is a very long journey, right? So you have to be very patient, very persistent, and really believe that this is where the future is going. So,
all right, I think that's a great place to wrap up, Carlos. This was super interesting. Thanks again for coming on the podcast.
Well, thanks, Camila, for the invite. It was a pleasure to talk to you.